Just want to ask you something before you get to your report, which we do a lot. The big question from investors right now, what's really behind the sell-off? Steve Liesman joins us with a look at some of the answers. So you got to have answers for what's behind the sell-off.
I have some answers. You're not going to like them, though.
Okay, well, my question for you is that when you got 30-year bonds so valuable and so much demand, why don't we now know that modern monetary theory works and that we can run trillion-dollar deficits and never think about it again? Why isn't this?
Question for John.
Yes, maybe that's the question for John. Why isn't it a good thing that it doesn't matter what we spend? Because people are going to we're going to be able to float whatever we want to float whenever we want to float it. It even go 100 years, go 1,000 years.
You can do all that, Joe.
So modern monetary theory works.
Until you can't.
Until you can't.
Until you can't. I mean, I think it's.
We've been waiting for the till you can't time for a long time.
We have been, and I have been a person who has been skeptical about the people who have these dire forecasts on the deficit.
But are you not amazed at the 30-year being all-time low yields and the most valuable piece of paper on the planet that we've never seen before?
I am, but I'm interested in the idea that the thing that the bond market cares about most is inflation. The next thing I think the bond market cares about most is where it puts its money next. And it's the fear that I will invest at a lower yield that I think keeps people going into this long-term paper. And, I mean, look, we tried to do the exercise the other day. I'm going to give Peter $100 for a year. I'm going to lend him that money, and he's going to give me $10 back. And I'm going to give you $100 for 10 years, and you're going to give me $5 back. Right? The idea that you should be paying me more, but it's the other way around. It's the inversion that is so curious.
What did you say about the German? The
30-year is minus 20 basis.
Minus 20 basis.
Let's just skip real quickly, folks. We'll skip all of this. What I want to show you is that the president has blamed the Fed, but the tail of the tape is essentially that it looks much more closely tied to trade. If you guys want to skip to the full screen that I have created with the data on it that I looked up. Okay. In the 24 hours after the Fed meeting, the market fell and it came back. The S&P was only down 6 points in the hour before the president tweeted that he was putting new tariffs on. In the 24 hours after that, the S&P fell 86 points. So people blame the Fed. In fact, it looks more tied to the president's tweet. Then go ahead and look. The yuan fell. That was worth another 60 points on the S&P. And then you come back and the tariffs were eased. That was plus 60.
So these are 24-hour moves. If you go back to December when we were at those lows and the Fed reversed course and look at a 3-month effect of what happened, you have a huge bounce back in the S&Ps in the face of all the tariffs and the trade wars continuing. So a 24-hour move, the knee-jerk move is never right.
Joe,
but you see what I'm saying? You're doing
no, I don't, because
you're doing 24-hour moves, knee-jerk reactions to whether it's
those are the market reactions to what is happening.
How do you know
and those things add up. Those things add up one after another.
Did we not go to new highs while the trade war was happening after the Fed reversed course?
Did we go to new highs
in the averages after the Fed reversed course in December and said they were no longer going to tighten?
Did, Joe,
and the trade war was still continuing the entire time.
And this is why I keep a very careful track in our surveys of what market expectations are. And this is what I think is really key. The market has been burned, I think, twice and maybe 3 times in its outlook on trade. We had the market pricing in a tariff agreement in 2018 and 2009. That was burned. That did not happen. Then we had the market pricing in that they would continue talking. That was taken away. So those are the things that I think are the unexpected moves. Meanwhile, if you look at a 1-year chart of the 10-year, there has been an amazing amount of easing in this market. 150, 170 basis points of easing if you look at the 10-year. So I'm just saying you can blame the Fed, but what does the market do when these things happen? It prices in more Fed rate cuts and more easing in the economy.
The Fed has done 400 basis points, and they're way behind now and need to go 50 next.
They're not behind in the sense that the market has priced in substantial amount of easing, and it's already in the economy. We wouldn't have inverted
if short rates were much lower.
I think that's probably true.
So then we wouldn't have a recession, so it's all the Fed's fault.
The Fed priced itself, Joe, for a market where China and the U.S. continue to talk, for a market without additional tariffs. That was the world on July 30th. The day after that is when the world changed.